Hi, welcome to this brief presentation on systematic investment plans in mutual funds. Financial history tells us that stocks give much better returns than other asset classes like bond, gold, small savings, etc. The superior returns delivered by stock investment is a global experience. Let us look at the experience in India during the last 40 years. During the last 40 years in India, gold has delivered an average annual return of 10%. Bank deposits have given an average annual return of around 9%. Small savings like national savings certificates have delivered slightly above 9% average annual returns. But returns in stocks as measured by the Sensex have delivered returns of more than 16% a year. The Sensex was 100 in 1979, and now it is above 37,000 as I speak to you in October 2019. So this translates into an average annual return of more than 16%, excluding the dividend. Investment of 10,000 rupees in Sensex stocks in 1979 would be now worth 37 lakhs of rupees. On the other hand, 10,000 rupees deposited in a bank in 1979 would be now having a value of only 3.2 lakh rupees. The difference is huge. Therefore, the stock markets have delivered a phenomenal wealth creation in India. But a very important point that has to be understood is that the markets are very, very volatile, and therefore the returns also will be very volatile and erratic. There will be boom phases in the market, there will be bear phases also. There will be some years of spectacular returns, there will be some years of mediocre returns, very poor returns, and once in 5 years or so you will have even negative returns. Therefore, the superior performance of stock investment will manifest only in the long run. So if you look at the history of successful investors, you can find that the successful investors succeeded in creating wealth by buying good quality stocks and remaining invested for a long period of time. Even though Indian stock markets have delivered excellent returns during the last 40 years, only a small minority of Indians have benefited out of that. The reason is very simple. In India, only just about 2% of the people have invested in stocks. Because of financial illiteracy, people have not invested in stocks and mutual funds. Therefore, they could not participate in this phenomenal wealth creation that has happened during the last 40 years. So if Indians are to benefit from the India growth story and the wealth creation that is happening through the stock market, they should invest. So how should people invest in stocks? Broadly, there are three ways by which you can invest. One, you can directly buy stocks. Second, you can invest through portfolio management services. Third, you can invest through the mutual funds. Portfolio management services is only for the high net worth individuals, rich people, because the minimum amount required is 25 lakhs. Direct investment in stocks can turn out to be very profitable, but then it requires time and also expertise. You need expertise to identify good quality stocks, identify sunrise industries, analyze the macroeconomic environment. So that requires expertise and time. Vast majority of the people do not have this expertise and time. Therefore, for the vast majority of people, the best strategy would be to invest in stocks indirectly through the mutual fund route. You can start with as small as 500 rupees a month. So this is for the ordinary people. This would be a good strategy for inclusive growth. So how do you invest through the mutual funds? Now, what are mutual funds? Let's start with the basics. Mutual funds are financial tools that mobilize the savings of investors and invest this money in assets like equities, bonds, etc., in accordance with the financial goals of the investor. Now, how do you invest in mutual funds? Broadly, there are two techniques. One, you can invest lump sum in mutual funds. So, say you invest 1 lakh, 2 lakh, 5 lakh, 10 lakhs, etc. Or you invest periodically, systematically, small amounts of money over a period of time. Now, bulk investment can turn out to be profitable if you are smart enough to identify the trough of the market. If you make a lump sum investment at the bottom of the market, at the trough of the market, then you will succeed in making big money when the market turns. But practically, it is very difficult to time the market. Therefore, the foolproof strategy for investment is to invest periodically, systematically, regularly, ideally every month. A small amount of money, depending upon the depth of your purse, every month through systematic investment plans. That is the ideal investment strategy. A major problem in retail investment is, or a major problem or an issue with retail investment is the issue of timing and the issue of pricing. Let me briefly explain that. Retail investors normally come to the market, jump to the market at the peak of the market when the valuations are high. And when the market corrects, particularly if there is a crash, they panic and exit from the market. So, the timing is often wrong. Retail investors often get it wrong. Secondly, the pricing also is wrong more often than not. Normally, retail investors buy more when the price rises and they buy less when the price falls. This is just the opposite of an ideal investment strategy. You should be buying more when the price falls and buying less when the price rises. If you are adopting a systematic investment strategy, these two issues of pricing and timing can be sorted out. So, ideally, investors should go for a systematic investment plan over a period of time, 3 years, 5 years, 7 years, 10 years, depending upon their financial goals. Also, investment in mutual funds give tax advantages. The long-term capital gains arising out of mutual fund investment is exempt up to 1 lakh, and beyond 1 lakh is taxed only at 10%. Dividends are taxed only at 10%. And if you are investing in ELSS schemes, equity linked savings scheme, the investor is eligible for a tax relief up to 1,50,000 rupees under the section 80C of Income Tax Act. For debt mutual funds, there are indexation benefits. So, there are a large number of benefits to be enjoyed from the tax angle also. Ideally, a good investment should have 5 attributes. It should give good returns, it should give capital appreciation, it should be safe, it should be liquid, that means it should be capable of converting into cash at short notice, and it should be tax efficient. Stocks have all these 5 qualities. Good quality stocks and equity and hybrid mutual funds have all these 5 attributes of a good investment. Therefore, go for systematic investment plans, SIP and grow rich. Thank you.